Hello, everyone. Welcome to this month's version of the First Bank Center for Family-Owned Businesses webinar series. We're grateful that you're with us today. We know you have a lot of choices of where to spend your time, and we appreciate you taking the time to be with us today. The discussion today is very pertinent and relevant to what's going on in our world. As we all know, we inaugurated a new president yesterday, and with that will always come changes in laws and the economy and forecasts and so forth. You've probably attended your share of forecasts throughout the years. We're excited about what we have today. I'll introduce our moderator, Pete Richardson, our managing director from First Bank in the Midwest here momentarily. But I just wanted to, again, share with you on a quarterly basis here at First Bank, we host these webinars on a variety of topics that are relevant to you, the business owner, the business leader. Some of you on here are entrepreneurs just getting started. Some of you run multi-million-dollar companies. Many of you work for some of those companies. And some of you are our friends and colleagues here within the bank at First Bank as well. So I'm Ed Hart. I'm the director of the Center for Family-Owned Businesses. Joe Ambrose, our executive director, and I wish to welcome all of you on behalf of Michael Williamson, our CEO, Mike Dierberg, our chairman. We hope you can benefit and gain from the knowledge that you glean from today's discussion. And at the end of the meeting, or throughout the meeting, we have the Q&A and the chat open. Probably going to hold most questions to the end, but if our presenters feel like there's a question that's relevant to the topic they're on, they might see the question and jump in and answer it. Otherwise, we will hold the questions till the end. This meeting is being recorded. None of your pictures are on screen other than our presenters. You've all been muted, so there won't be any verbal there, but you can communicate with us through the chat and the Q&A. We will post the link to this webinar on the Center for Family-Owned Businesses website on the First Bank domain in the coming days. So if you can only sit with us for a portion of the day today, you can see the entire presentation after today, and also share it internally with your folks and externally with your clients as well. So with that, again, thank you for joining us today. First Bank greatly appreciates your time. And with that, I'm going to turn the time over again to our managing director for the Midwest on the commercial banking side of things at First Bank, Pete Richardson. Pete, take it away.
Great. Thanks, Ed. Thanks, everyone, for joining us in attendance, and thank you to our presenters. And without further ado, I'll do a brief intro of our presenters and let them get to the topic at hand. With us today, we are honored to have Joe Brusuelas, Chief Economist of RSM. Joe is an award-winning economist with more than 20 years of experience analyzing U.S. monetary policy, labor markets, fiscal policy, international finance, economic indicators, and the condition of the U.S. consumer. He's a member of the Wall Street Journal forecasting panel, and he frequently offers his insights on the U.S., Canadian, and global economies in the financial media, among many places, some of which are CNBC, Cheddar News, the Wall Street Journal, the Washington Post, Yahoo Finance, the Financial Times, the New York Times, and I think the list goes on. So we're really happy to have him here with us today. And currently at RSM, Joe is the co-designer of the RSM Middle Market Business Index and works closely with participants to help guide their industry-specific research and analysis on macroeconomic trends shaping the industries in which he and RSM serve. Joe has a PhD in economics from the University of Southern California. Thank you, Joe. And also joining us from St. Louis is John Horn. John is a professor of practice at Washington University of St. Louis. John's been working there since 2013, and I've had the honor of taking some of John's classes, and I'm way better for it. John, some of his areas of expertise are corporate strategy, economics, international business, international economics, management strategy, and wargaming, among others. And in 2023, John released a great book called Inside the Competitor's Mindset, How to Predict Their Next Move and Position Yourself for Success. Highly recommend that read if you're into strategy and wargaming. So thank you both for joining us. I will stop talking for now. I'm also going to hop off, so if people want to just narrow their screens down to the two presenters, and I can hop back in later to facilitate any Q&A or dialogue. But I think, Joe, you were going to give us kind of your outlook, and we'll take it from there. So thank you.
All right. So thank you very much, Pete. It's good to be here today. I know everyone's most valuable commodity is their time, so we will not spend that unwisely. So let's jump into it. The US economy is in an incredibly good place right now. The second half of 2024, it appears to have grown by over 3% in both quarters. The unemployment rate sitting at 4.1% right now. And we're adding, on average, really about 150,000 jobs a month over the past 6 months. All the while, we can continue to see some very slow improvement in the inflation outlook. At this point, we've got three tailwinds behind the economy. One's the US household, basically, who's now looking at a labor market that's plentiful, wages that have been growing above inflation for the past year and a half. And that's resulted in a real spending increase on average of 3 to 3.5% on every quarter for the past 3 years. The second tailwind is firms since the middle of 2021 have simply pivoted to investing in software, equipment, and intellectual capital, which is bolstering productivity. That fixed business investment continues at a very strong clip. And again, productivity is rising at about 2.5% right now. That's well above the 1.5% we saw for the previous 20 years or so. So that's one of the more exciting, encouraging things that's going on in the US economy. And of course, the fiscal tailwind, the investment in the CHIPS Act, which is resulting in the jump-starting of a modern, sophisticated supply chain here in the United States around microchips. Of course, the move to rebuild and modernize the US infrastructure, which was long overdue. And then the first steps towards a more sustainable environmental policy, which includes quite a bit of environmental remediation cleanup around the country. All of that's combined to really put the United States on a growth path near 2.9% over the past 3 years. And that's well above the 1.8% path that really represents the long-run growth trend. Now, the Federal Reserve cut interest rates by 100 basis points in 2024, and that's brought the policy rate to a range between 4.25 and 4.5. Now, our forecast, we think there's likely to be two rate cuts, one 25 basis points rate cut each, once in June and then another one in December at the end of the year. And that should bring us to the end of the rate cutting cycle that the Fed started last year, or a couple years back. Now, what's important here is that the economy is going through something of a regime change. That low inflation, low interest rate environment that we all got used to from 2000 to 2020 is essentially over. The large global macroeconomic shocks of the pandemic cleared the decks, along with the considerable casualties that were took during the pandemic. Instead of having an economy characterized by insufficient aggregate demand, a global savings, low inflation, and low interest rates, we now have a situation in which public and private actors are competing for scarce capital. There's insufficient aggregate supply, both in real terms, labor supply, and then what's going on, obviously, in technology has resulted in capital being channeled into the creation of a new ecosystem organized around artificial intelligence. And of course, that competition for scarce capital has resulted in higher interest rates. And following the shocks of the pandemic, it appears we've evolved into a higher inflation environment. That's going to require a very different policy stance. Now, we expect the US 10-year to average 4.5%, trade between 4.3 and 4.7% this year. Now, we think that's about right, given what we expect to be around 2.5% growth rate this year, which is our forecast, and about 2 to 2.5% on inflation. Now, my sense is we're going to test 5% on the 10-year yield. Now, for everybody on this call, whether you're affiliated with a local or regional bank, or you're a small business who tends to borrow from these banks, that 5% is critical. Now, the last time we tested 5% was in the springtime of 2023. That resulted in essentially a mini banking crisis amongst the local and regional banks, who are holding about 70% of the commercial real estate portfolio outstanding. Clearly, Silicon Valley Bank, which was the trigger for a lot of this, had a large unhedged position that was really just classic bad banking management. But it did result in the Federal Reserve having to step in and ring fence that community in order to preventively stop a bank run. So the economy's in a good space. It's got a very good tailwind. It's likely to receive further tailwind via what we think would be a pretty big tax cut coming for firms at the end of, say, mid to end of this year. A much more business-friendly environment, especially around regulation. And those are the good things. Now, the risks are, and I outlined the first risk, which is as rates move higher, there's going to be a test of the local and regional banks, and we'll want to see how that goes. Second, we got frothy financial markets. Equity valuations, I think by any measure, are clearly stretched because the spending path relies upon the upper 2 quintile of income earners, 40% of households, that they're responsible for over 60% of all spending. Should there be a large correction, that would cause the economy to slow. Clearly, what's going on geopolitically, anything linked to do with the Middle East or Russia and the price of oil, all carry the catalyst to cause the economy to slow, but not really, I don't think, tip over. And then, of course, the potential around tariffs, trade war, and much tighter immigration, all could upend what I think is a pretty good growth path right now. So I think that in about 10 minutes, that's a pretty good synopsis of where the economy is, where we think it's going, 2.5%, 4.2% unemployment, strong above inflation wage growth, all accompanied by an inflation rate that's going to be around between 2 to 2.5%. All right, Pete, I want to throw it back to you. Thank you.
All right. No, thanks, Joe. John, I mean, I guess we'll start out with you, just general observations, commentary. You guys want to get into a brawl between his outlook and yours? That's what the people came to see.
Yeah, I think everything Joe said, I would agree with 100% in terms of the economy right now is doing as well as it probably could be doing. I think the rest of the world is, broadly speaking, envious of the economy that we have and wish that they would have the inflation rate, the GDP growth rate, the outlook on unemployment that we have. By any measure, I keep saying if you had told incoming, an existing administration 10 years ago that the stats that Joe just rattled off in terms of the economy would be the status of the economy as you entered your reelection, time frame, I think every administration would have been like, yes, please, that's fantastic. I will take that in a heartbeat and get reelected for another 4 years. And yet we saw a complete shift. And I think that to me is the big unknown. A little hyperbolic to say maybe we call them black swans. We don't know what we don't know. In our pre-call, we talked about, is it really a black swan or not that we could be addressing? I think the way I look at it is less of there are things that are going to happen that we have no idea could possibly exist or have ever existed before. I think the way I look at it is there are a lot of low probability events that could be happening, mostly driven by active choices by the new administration, as opposed to changes that are just systemic shifts and reactions in the economy. And I think any of those happen or some combination, the economy is a pretty fragile thing. It's hard to get the balance of a macro economy correct so that it grows steadily, consistently, in the type of path that Joe talked about and described, but it's very easy to mess up an economy. And I think that from what we saw even yesterday with some of the executive orders, if there is a large deportation of undocumented workers in the United States, that will have a massive reduction in labor, and that is going to increase the wages and the wage requirements to hire workers in a lot of other jobs. The president has said he's going to have some infrastructure announcement today at 3:00 Central, 4:00 Eastern. We don't know what that's going to be. Is it a continuation of the Biden administration or some complete revamp? We don't know. Where's that investment going to be focused on? What's it going to include? And so I think the way I look at it is I again agree with Joe 100% that this economy is fine. This economy is doing well. And yes, there are places where it could be tweaked, and lower income workers in some counties and rural areas that we need to be investing and shifting and focusing. All that stuff that normally happens on the margin. I think the concern for me is, 25% tariffs or more on our three largest trading partners will spur inflation. And if at the same time we need to investment, that's going to be hard because you're going to have to lower interest rates or raise interest rates to fight inflation, but lower interest rates to cause more investment. And you start to get a lot of things which fight for attention, and that's when economies tend to stumble and get in problems. And that's my concern, is that if this were just a normal transition from, we want the corporate tax rate to go from 25% to 23%, or we want to shift, the deduction of mortgages and put it back in, that's on the margin. But I think what the current administration is talking about is some potentially massive reformulations of how the economy operates, and could pose risks if they're all implemented, especially at the same time.
Okay. Well, and I think with that, I think there's a lot to talk about with the administration, but I think tariffs, it comes to top of mind because even go back to your economic, basic econ textbooks, tariffs are in that book more than they may be in a lot of other books. So and we've talked about it a little bit.
We talk about them as tariffs. They're taxes. And we know that when you raise taxes by 25%, like if there was a 25% increase in the income tax, no one would be happy and say, oh yeah, that's fine. Business as usual. It's a tax. And it's that slows down economies.
Right. Well, and they do seem to be, if there's 25% increase, or China might be 60, and maybe it's a universal, or maybe it's just on BRICS, or maybe it's Mexico, Canada, and China, or Mexico, Canada, and BRICS. I think that could be, is obviously going to be inflationary, fundamental nature. I guess, do you guys have a perspective, or what are your thoughts, or read and talk when inflationary pressures like tariffs run into the mandate to try to reduce inflation, right? So if you're going to do two contradictory things, do we think that the tariffs are just maybe negotiating for, maybe not a trade war, but a trade dispute? And you guys want to just speak to that?
Right. Well, a couple things. I think first is there wasn't an executive order last night issued on tariffs. There was a memorandum, which means it's not legally binding. And it directed the relevant agencies to report back in around April 1st. So there was no tariff announcement last night, which was a relief. But then, of course, the new president couldn't help himself. He had to say, well, I might want to do tariffs 25% on Canada and Mexico by February 1st. Okay, so what we do is we get into this situation where we have to begin to model out what this looks like. And it can become a real challenge, right? Because in the real world, you increase import taxes on one country, you're going to get a retaliation. They're likely to increase their import or even their export taxes, right? They're going to engage in currency depreciation, sometimes beggar thy neighbor type of depreciations, which can get large and nasty. They erect non-tariff trade barriers. So it gets very complicated. Trump 1.0, we didn't have a trade war. We had a very light trade skirmish in my estimation. Now, what I read in the memorandum looks to me like they're setting the predicate to do a universal tariff, right, against all goods. Now, that would really change the global trading system. Now, what we went through in 2018, 2020 was a very select, very small trade skirmish that didn't result in inflation. It resulted in higher prices on the things the import taxes were placed on, but it did not result in a general increase in the price level that was sustained. Now, a trade war, a universal set of tariffs, well, that probably would. And in that case, you get at cross purposes with yourself. When you want low interest rates, but you're putting in policies that would, if indeed those were implemented, likely cause inflation, Federal Reserve would lift rates. Right now, we've done some formal modeling of all of this. So if I model a 25% tariff on everything from Mexico and Canada and a 60% tariff on everything from China, over 10 years, the US economy ends up 2% smaller than it otherwise would have. That's not what you want. It's not what happened after Brexit, where the UK essentially did something similar, right? They voted themselves off the European island, and they have an economy that's 5% smaller than it otherwise would have in less than 10 years. Those aren't what I would call optimal outcomes. But this is what happens when you remove the market as the driver of price action and you insert the state. To be honest with you, the right-wing populists are now doing what I worried about the left-wing populists were going to do 20 years ago, right? We're going through a political realignment. They're changing sides. Now, over the longer run, I'm more interested, what I fear more is what's going on in the immigration, as John pointed out. By 2033, we hit a demographic tipping point because we're just not producing enough replacement population. And we start to shrink. The labor supply just flattens out completely. And at that point, we'll be completely dependent upon immigration to grow the supply of labor, right? And remember, this isn't a market-derived outcome. This isn't what anybody who's a banker or a small business person would want.
Yeah.
It's the opposite. And so what you're doing is we're going to make choices now that are going to constrain ourselves. And it's why I mentioned that regime change. The end of that secular stagnation has now turned into a very different economy that looks more like what we had before the big crises of the early century, right? We're going back to the future. Again, higher inflation, higher interest rates, a competition for scarce capital, insufficient aggregate supply, right? Which drives that competition. And so we're going to have a real healthy discussion about this over the next several years, right? And why am I interested and what do I fear about this lack of immigration? Well, the American public's made a decision. They want less of it. It's particularly ill-timed given the changing demographics. And what happens is the unemployment rate falls. Okay, people will be very happy. Wages start to go up. For a period of time, people will begin very happy, but at which one point the central bank will say, this is beginning to look like a wage price spiral. We better preempt this. And you start to hike rates, which of course then slows down the economy, right? And there are all sorts of equilibrium traps we can get caught in, which is another discussion for another time at one of John's classes, right? But I think that's a good, outlining of the risks based on your question.
Yeah, and I think the double risk on top of that is because of the shift in the focus on trade, is that it cuts off the opportunity to re-optimize supply chains globally to find cost savings to offset the wage increase that you're paying in the United States. And so that wage increase is going to have to be passed on in terms of higher prices, almost certainly, and that will again kick off inflation and all the stuff we talked about.
And I want to emphasize here, and this is really important, the inequality that describes the U.S. economy started before I was on this earth, before I was even a gleam in my daddy's eye, right? This is just the way this is. It's easy to go in and break down the U.S. household by either deciles, 10% at a time, or quintiles, 20% at a time. And when you do this, what you find out is the economy is driven by the upper two quintiles, essentially, right? That upper 30%. If I get really dense and I go a little bit higher, there's a portion there where they're responsible for over 66% of spending. It's really ridiculous in some cases. And when you see housing prices go up, when you see the equity market go up, that creates a leverage effect, especially for the upper 20% or the upper 10%. And they really drive the economy. Should there be a big setback in financial markets or a problem inside the bank, say via the private credit and private equity channels, the economy would slow. And a lot of the policies that are being put in place, well, they would be inappropriate because you'd need the trade channel. You'd need an increase in demographics to bolster, right, activity. And these are good things to talk about now because the conditions are changing very rapidly on us.
Right. Well,
And I think
guess,
just one other challenge, one other thing I would throw in there, I think what is challenging also is that when, macroeconomists like Joe and I, who look at the overall state of inflation, the state of unemployment, it's mostly looking at the broad overview of the entire economy. And I think what's been challenging is that we're seeing a lot more pockets where we have strong growth in some areas, weak growth in others. And as you start to see the shrinking or the consolidation of the population, that's not going to be spread like peanut butter across the United States. And the increase in housing is not going to be spread like peanut butter across the United States. And if we get mismatches of where housing is built versus where people need housing versus, you could argue, well, the market will take care of that and we'll build the houses where the markets want to build houses. But, on the other hand, if we see how that policy is put in place doesn't incentivize the
and let's
etc.
Let's call it what it is, John. We've had a market failure in housing.
Yeah.
That started with the great financial crisis.
Yep.
And it's been building for 20 years. The market's just not working. There's going to have to be a public sector driven solution. And right now we're just not ready to have that conversation. We just aren't. It's going to have to happen, but it's not. And John brings up a great point about how the peanut butter's not spread out evenly across the bread. You throw a 25% tax on everything from Canada. Well, what's interesting is our oil refining capacity in the Great Lakes and Rocky Mountain region is only set up to take that heavy Canadian crude. It doesn't take the light sweet crude we produce here in Texas. The government were to do this and not carve out an exemption for oil, and that's a big if they were not, prices would jump 20 to 25% in gasoline in those regions. Those regions are not populated by that upper quintile that I talked about.
Right.
Those are the good, hardworking, median, working class, middle class folks who are still reeling from the price shock. Now, why you'd want to do that, well, that's a different question, perhaps for a different day. But the micro and macroeconomics of this are solid.
Yeah.
They hiked tariffs by 25 basis points. There's no carve out for oil. That price of gasoline is going to jump 20 to 25% within a matter of days, right? And so these are things that we should be having these discussions, even amidst a very good economy, because I'm seeing economic emergencies being declared yesterday and today, and I'm like, what emergency are they talking about? Because
I think energy, energy is
a
great example. I looked up online, the Energy Information Agency of the United States showed that in the last 2 years, we pumped more oil than any country has ever pumped in the history of the world. And we have produced more energy in the United States by 9 quadrillion British thermal units than we actually consume. So we are a net producer of energy, and yet there's an energy emergency. And, I think you point out rightly, it's not just energy, it's the source of the energy. How are we producing that energy? And if there's a reduction in investments in green energy at the same time we tax oil, and it's not just there's this overarching thing we have to worry about. That's why I said, it's really easy to mess up an economy. There are a lot of moving parts you have to get right to try to build an optimal economy, but it's easy to mess it up.
Well, I'd be curious though to pull that thread a little bit more on energy. Because, I think some of the executive orders were opening up more federal lands for exploration, more offshore drilling. And I do know, and I had read, that we had been producing more oil than ever. And I think, but, Trump has come out and said, no, we're going to totally restock the strategic oil reserve. We're going to open more places where we're going to export more oil. So if we're talking about tariffs increasing prices or being that tax, how does
Okay.
a larger glut or a larger supply of oil
I
kind of
think the
impact
first thing
things?
is that the federal government controls a lot of land, and it can increase land that can result in more supply in terms of fossil fuels, right? Oil. All
Mhm.
right. Now, we're producing about 13.3 million barrels a day. That'll be over 14 million barrels a day next year. That was separate and distinct from anything that was in an executive order last night, right? That's going to happen.
Yep.
The price of West Texas Intermediates floating around $75 a barrel. There's going to be about a million barrel per day surplus globally, which means once we get through this issue with Russia, right, the sanctions and the market adjust the geopolitical risk premium, it should trade between 65 and 75. Now, for many years, the oil industry was engaged in widespread speculation. It overproduced. It was a real mess, to be honest with you. And it took about a decade for the oil uh, sector to clean itself up, right? No help from public sector. It had to experience hard times. Okay. Now, I hate to tell you guys, you can say drill, baby, drill as much as you want. It's not going to result in an increase in supply with oil at $65 a barrel and
Mhm.
extraction costs anywhere from $25 to $45 a barrel. That just doesn't, the economics of that doesn't make sense. Today, 3 p.m. Eastern, there's going to be an announcement. There's going to be 500 billion private sector money that's going to go into AI infrastructure. Now, most of that's what we call data centers, but there's going to need to be AI energy infrastructure,
Mhm.
right? Now, perhaps over time, the price of oil will trend back up as the global economy gets back on its feet because it's hurting right now.
Mhm.
When the price of oil goes up, then that federal land will be developed and we will export more oil. Some of it, presumably, though, will be redirected into energy so that the AI infrastructure we need to create the next economic revolution will go forward. A part of that's going to be natural gas, part of that's going to be oil, there's going to be some nuclear there. But things are moving along at a pace that is somewhat inconsistent with the PR nature of politics.
Yeah.
Again, you
Yep.
can say drill baby drill as many times as you want. I can tell you who that's popular with. I can even tell you where to put the advertising.
Mm.
It doesn't mean that the gentlemen in Houston are going to pump more oil,
Right.
invest more. It just
Right.
doesn't. The economics right now just don't make sense.
And I
Right.
think especially when you add to the fact that the timing of building a factory to produce solar panels or to produce wind turbines relative to exploring, prepping, producing, and getting a field, because remember, these aren't the easy fields where we've already pumping oil have already been leased.
Yeah.
The next land is going to be harder to extract oil from, just like you do the easy stuff first. That's why it's called low hanging fruit. So it's going to take longer, be harder, be a longer term bet. And when you have a much easier path to build alternative energy sources to try to fund we need the data center now, not in 20 years. It creates this mismatch of timing. I agree with Joe. It's nice to say, but we don't know if it's actually going to happen.
Nope.
And we do need energy, and we need it now. And that's why it's hard to believe that it's just going to be a gusher of oil that will suddenly start spewing, in the summer.
And there is global demand for liquefied natural gas.
Mhm.
Our friends in Western Europe, Northwestern Europe need it because
Yep.
they've been cut off from energy sources to Russia. That's not going to end anytime soon. So
Yeah.
that's going to be a source of development, but we're not sure about the economics of that yet.
Yeah.
It's
Right.
too early.
Yep.
Now, I'm sitting here today in Austin, Texas. 2.5 hours south of me is the petrochemical capital of North America. We have clients there, right? In Travis County, where I live, over 50% of energy is now provided by wind. I'm sitting in a house that I built 2 years ago. We have a 25-foot ceiling. So we like it very much. I would have never built this house 10 years ago because the cost of air conditioning and heating it would have been what I considered unreasonable, or to be honest with you, I wouldn't have been willing to pay it.
Yeah.
Instead, because we now have a diversified resource base, that wind has been translated to incredibly cheap electricity.
Yep.
So the market is speaking in a way.
Yeah.
And
Yep.
by the way, guess who owns the alternatives? Same guys who own the petrochemicals.
Right.
Those are the smart guys. They've been
Yeah.
behind this,
Yeah.
right?
Yeah.
So we're moving along. It's going to be economic beneficial that we pay attention to the market here, not to clever PR slogans.
I've got, if we have time, I might come back to the political PR, and John, I'll see if you eat lunch with any poli-sci professors at WashU. But we have a question here that I think is probably, this is somewhat specific, but probably on the minds of a lot of people on the call. We have a customer, a California-based customer, but their company is headquartered in Canada, but they have an office in Irvine. And they've discussed the possibility of setting up a completely independent American company if there happens to be that 25% tariff that would affect Canadian goods.
Yeah.
So, either that specifically or more broadly, I think folks are just looking for maybe ways to prepare themselves or try to insulate from, if it becomes trade war-ish, not trade skirmish-ish.
Okay. So we've been advising our clients around this since the trade skirmish, right? Whether it's a skirmish or a trade war at this point, you have to begin thinking about diversification to reduce your exposure to risk, whether it's a supply chain or whether it's taxes via fiat. I'm going to fly to Chicago. I'm going to talk to a company tomorrow and their board who own a firm that imports exotic foods from Canada. Now they're already got a pretty big tariff on it, and it would be more. And they can't really find a ready substitute. So one of the things that firms are going to have to do is they're going to have to consider becoming an independent American company to try to land under whatever the carve out is from whatever new tax regime is imposed. We're talking, everybody here is either a small business person or they're affiliated with the local and regional bank. You're not Apple. You're not going to be able to purchase a carve out, right? One of the problems with tariffs, tariff regimes, things that are highly selective and idiosyncratic, is you don't have the predictability and the rules that governed trade for the past 30 years. So we're moving into this new era, this new framework. And so for that in particular question, Pete, yeah, they strongly should consider becoming an independent American firm.
John, I don't know if you had anything to add as far as how do you prepare and insulate even more generally.
No, I really don't have much to add. I would agree 100% with what Joe said. I think that to me is part of the risk with the political implementation. I agree that part of the reason it wasn't a trade war with China back in the first Trump administration is there were a lot of carve outs and there were a lot of focused areas where the tariff will be on this, but not on this. And then there was some pushback of, well, now the price of this thing that had the tariff got too high. Okay, we're going to reduce that tariff, but we're going to put it over here. And that's where, broadly speaking, we don't know whether these threats of 25% tariffs on Canada and Mexico in order to close the border and reduce the flow of fentanyl, if they come back and if the governments of those two countries come back and say, yep, we're going to stop the flow of immigrants, we're going to stop the flow of fentanyl, and Trump claims victory and says, okay, then no tariffs. There was a little bit of that with the China skirmish back in the first administration where there were these large tariffs and said, but you have to buy more of our stuff or else the tariffs are going to get worse. And China said, yeah, we'll buy more stuff. And victory was declared. And now in hindsight, looking back, they didn't buy more stuff, but they said they were going to. Is that going to be enough to say, nope, tariffs are that we got what we wanted and so we're done? Or will it be, I'm not going to be tricked again and fooled again by your promises. We're going to push this through and we're going to force it until we actually see you buying stuff. So, and will there be carve outs for certain constituents, for certain groups? You know, yes, the large companies have the ability to do so, but I think this would also be something where it would be, I think, be in the best interest of a small business owner to talk to industry associations that they belong to sort of see what are the rest of the constituents of that association thinking, and is there an opportunity, you know, in Washington to try to collect your voices together to shout and say no, that, you know, not on this product or not on this service. But I think the unpredictability of where the tariffs will hit, and even things like, are the tariffs going to be imposed to the same, you know, would there be a carve out if you were an American subsidiary or American company, whereas if you were a subsidiary of a foreign company, we would have a tariff that you can't be, you know, you have to pay the tariff if you're importing goods, intermediate goods as the subsidiary. But if you're a wholly owned American company, no, you don't have to pay the tariff on intermediate goods, but everyone has to pay it on final goods. Again, it gets really complicated of like, not peanut butter. It becomes chunky peanut butter, right? And that's where diversification and having optionality, I think, is going to be the key, because it's not predictable about what's going to happen.
Right. You know, and I do think that is one thing we've talked to, you know, our clients about too, is, you know, what are you importing and what's the criticality of those things? And of the super critical things, do you have other suppliers and sources, whether it be other countries that might have a different tariff, but or critically, and maybe what some proponents of the tariffs would say, do you have a domestic supplying source? But even if they are domestic, how much of their domestic is domestic?
Right.
Well,
Are they importing it, shipping it to you, importing it yourself? So yeah,
it's very important that if you're talking supply chains, that you're inside the North American supply chain, where there are a lot of rules around it. During the trade skirmish, we had a client who produces glass that feeds into the southeastern United States supply chain for housing construction. Now, they had a new factory and an old factory. And under the way in which NAFTA was renegotiated, it made sense for them to close the old factory, shift all of the demand over to the new factory, and they built a new facility inside the United States and avoided the increased tariff that was placed on firms that imported from Mexico and the United States, but had wages below a certain level. Okay. Essentially, they just chose to make themselves more efficient. Right. And so, it's going to go case by case, company by company, based on product by product, right? I hate saying that as a macroeconomist, but it is true.
Right.
It's absolutely true. It's why we've got a nice consulting arm in our business, because we talk to our clients about these things and we get very granular with them. But you're spot on, Pete, about what this means in terms of, you know, the product.
Yeah. And then, John, we have another question here in the chat that I will kick this off to you, since you're the wargaming expert.
Mm-hmm.
When you're talking wargaming, we're not normally thinking about like Spanish-American War, U.S. expansionist ideas. But if, you know, where I think a lot of us think it might be political PR, but if, you know, Trump does make moves to try to get Greenland within our territorial sovereignty in some way, or the Panama Canal, I mean, how much time or thought have, you know, economists put into that and the ramifications of that? Because I'm guessing it's not, you know, it was not in your curriculum last year.
No. You know, so business war games really are not about geopolitical conflicts per se.
Right.
They're really just an opportunity to test scenarios, exactly like the kind that, you know, Joe was discussing, in terms of, if we build the facility here, what do the economics look like? If we build the facility there, what does it look like if we transition, et cetera, et cetera. But the differences with the war game is you have someone on the other side saying, but if you build that facility in the United States, we're going to build one right next to you, and so you're going to lose your opportunity. Or we are going to instead shift our purchasing from your facility in the United States to a facility in China, whatever it is. And it's that active choice of someone else who responds, which separates it from the I control the spreadsheet of the model and therefore tell all the actors what they do. I think this, you know, Greenland is, it feels like it's something that's just I'm going to, say it to say it, and therefore it's not really going to happen. I think this would fall into, clearly, if we want to call them black swans, but a low probability event. That could have potentially big impact. And I think the larger probability would be that there's going to be some changed agreement where the United States, I mean, currently can essentially do whatever they want in Greenland, from my understanding, but maybe it's a little bit more of whatever they want in Greenland, or have the rights to control shipping routes or whatever around Greenland. But I think the one risk, the one risk I see is that as more and more of these geopolitical, you call them strongman moves, or you call them the madman moves, or whatever you want to phrase them out of, Trump saying, I'm going to do this thing extreme, and as other countries start to cave, does he start to get more and more aggressive or assertive in what he wants? And the analogy I use is, at some point the kids on the playground just say to the bully, look, we're going to go play our own game. And the risk is that the EU and China and the other countries eventually get fed up with it and say, look, we're going to stop trading with you, and we're going to have China technology focused. We're all going to trade with ourselves, and we're not going to trade with you. Again, I think because, as Joe laid out, the US is the strongest economy in the world, that's not a huge risk. But at some point, if you annoy the rest of the world enough, they say, we're done. We're gonna play in our own sandbox. And to me, that's the one big risk. Again, I don't think it's a huge probability,
right?
But that's where I see the risk coming in.
I think the questions around Greenland are well placed, but perhaps in a different way. The reason why this is happening is because we're going through climate change. Polar ice caps melting. The Northwest and Northeast passages are opening up. As the snow and ice recedes, there's going to be access to new minerals, rare earths, that sort of thing, right? I don't think this is necessarily a Trump-centric thing. This was going to happen anyways. It might have happened in a little bit more of NATO says, or the US and its Canadian and Arctic partners say, right, that we have this economic exploration zone that keeps the Chinese out and constrains the Russians, right?
Yep.
Because if you look at the map up there, you can sort of draw a triangle, and it just, the Russians on one side, the US, Canadians, and its NATO allies on the other, right?
Yep.
All right, so this is going to happen now, regardless of which party's in charge. Right. It just, you have perhaps a inarticulate president talking as if it's the 19th century, rather than a multilateralist president, essentially saying the same thing in prettier language.
Yeah.
Right.
Yeah.
Now, the one thing is, no small business is going to have access to any of this.
No,
this is going to be the province of large global multinationals and the U.S. Defense Department. So, but again, we'll all watch it.
So, Joe, that's actually a great segue into another really good question we have here. We have somebody on the line just looking from, again, the macro viewpoints. What factors, policies, other initiatives could we be looking for that could help? So I guess maybe if it was your platform, your administration, that could help spur, middle market and small business growth over the next 2 years. They're talking about, do we encourage innovation and R&D and things like that.
So in continuation of the rebuilt modernization of U.S. infrastructure, to finish the CHIPS Act, to play it out, and to continue along with what was called the IRA, but the Environmental Sustainability Act. Now, with respect to a specific policy, full expensing of R&D, permanent, ongoing. By the way, that should be paid for. That's that beneficial.
That it pays for itself.
Yeah. I wouldn't finance it. I'd pay for it. I would raise taxes to allow businesses to do that. Yep. That's fundamentally in the interest of small, medium, and large-sized businesses. Okay, lastly, the thing that's going to be announced this afternoon, it's a good PR event, but it's good to see because it's not publicly spent money. It's going to be private sector investment in the development of these AI data centers, which is the precursor for we're going to need to put together a pool of capital to put together AI energy infrastructure. my sense is we're on the cusp of the fourth revolution. It's going to be organized around generative AI, quantum computing, and synthetic biology. That we're going to need to evolve both our framework politically, economically, and then legally to support this. And we're going to have to put together the financing to deal with this, right? Those are all very good things. Oh, and by the way, I had mentioned earlier about housing. You know, I actually think the Democratic candidate had much better ideas about housing than the current president, because it's going to take the combined efforts of the federal government, the state government, and the localities to break the Gordian knot that's keeping supply from increasing around the economy. Because this is unfortunate, and I hate saying this as an economist, because I was brought up to believe markets don't fail. But my career, well, they failed often and sometimes spectacularly, like in 2007. And the housing markets, we've got a market failure. And we're going to have to figure out our way out of this again, because we're over 3 million homes short of what we need just because of demographic changes, right?
Right.
And that's going to have to happen. Or if not, people like me who own two homes with mortgages at 2% are just going to watch the equity in our homes appreciate. And slowly what happens then is you move away from a situation where I think about 67% of households own their own home. That will begin to shrink. To me, you're now treading on the American dream, right? You think people are pissed off now? Just wait. Right? I've told people in other forums, whichever party solves the housing problem is going to be the dominant majority going forward, regardless of their ideology. They're going to be.
Yeah. The one thing I would add to what Joe said is, and concerns me, is I agree that AI and data centers and artificial intelligence and intangible capital and infrastructure, et cetera, is going to be the next wave. As an economist, what I also know is those are very scalable industries and the largest player wins. And what that means for a mid-market and small business is you're not that winner unless, to Joe's point, we have some really challenging conversations about what it means to have a society, a political system, economy that is structured so that some of those benefits are not all captured by the Apples and Facebooks and Googles and open AIs of the world, because that is the most efficient way to provide those services. Like, we know that, full stop. How do we create a system where everyone gets to benefit from those, and it isn't just going to funnel to a certain small number of places? Because then again, we get the lumpiness problem. And I think that, to me, is one of the, I would put that on to what Joe just said about housing. Whoever solves that problem politically also is in a good position for the long haul.
Yep. And then I think we've got one more question here that I think we've touched on. And maybe it's a good way to kind of wrap this up but the fuller sense of the question is, does this new framework and some of the things I think the administration is doing, does it only last 4 years? But the last couple of things we've talked about really extend beyond 4 years. And, their question goes on to say, do you see any bounce back in 4 years or snap back to, more of our perceived normal, at least the last 4 years of normal? And then they also want to know if there was any positive of tariffs. And I think you guys even hit on that about saying, if it's a skirmish and you're saying we want relief for this and, various victories are declared, but things can be eased up. But I think in general, that might be a nice way to kind of wrap this up, is the 4-year time period versus the macro economy outlasting 4 years.
I would urge everybody to embrace the present, because that 2000 to 2020 era is not coming back. That's now an artifact of history. We're not going back to 1.5% inflation. It's just we're not. Okay. No, I think that in terms of tariffs, it distorts the way markets work. There are going to be winners and there are going to be losers. The government, though, is going to pick them, not the market.
Yep.
So if you think you're in an in-group, that's going to win, let's say, some portion of the auto supply chain that's more predominantly here in the United States, you may come out marginally ahead, right? But inside the integrated North American supply chain, the average auto part travels back and forth across the border 7 times. To be honest with you, there's no such thing as an American auto anymore. Right? But yeah, you may end up ahead. If you're in tech, I think they would be the big winners. That's more about national security than about trade, though. Right? But that's, I mean, look, trade, banks, financial services, energy, all figure to be the 4 big winners out of this. Not necessarily because of drill baby drill or even tariffs. It's just because of all of the direction that things were moving already. Those 4 economic industries are going to disproportionately benefit from what's likely to happen this year and its long-term implications.
Yeah,
John,
I'd agree.
you good with that?
I think, in terms of, the 4 years from now, I think the challenge I see is that there are a lot of these bigger issue problems, challenges, however you want to call them, that I think unfortunately have become polarized to it's either our idea or it's a bad idea. And I think that there are a lot of these ideas where we could have some cooperation, collaboration, agreement on some middle of the road solutions, but in our political environment, that's just unlikely to happen. And so I would go back a little further, the days of the 80s and 90s and even the 70s when we sort of got together and solved it as a bipartisan solution. I fear that probably is not coming back, at least in the next 10 years, maybe longer. But I think I would also agree with Joe that some of these things they're not bound by politics. They're just going to plow forward ahead anyway, because the market wants them to. And there's only so much you can do to stop it. And it's hard to build up the economy to make it happen. But like I said before, if the government wants to shut down a part of the market, you can always shut down a part of the economy. It's hard to build it back up. So as long as we don't shut down, we're probably okay. And to me, that's the bigger risk, is there's a massive wrench thrown in the gears. As long as it's on the margin, we're probably just going to keep plowing ahead in a lot of the same ways that we have. Remember,
this is going to be a good year for small business. We're growing at 2.5%. We're at full employment. Yeah. The inflation shock has ebbed. We're back to where inflation's growing at an acceptable and tolerable rate. The economy is going to do very well, and we're clearly going to be continue to outperform our G7 peer competitors.
Yes.
By the way, the dollar is going to get stronger. Those goods that we're importing, they're going to get cheaper.
Yep.
Right. So there's very good things going on, despite the nature to maybe sometimes overemphasize the risks around the outlook.
Well, that's a great way to probably wrap this up. On an optimistic note. So I'm happy we got there, and I'm going to quit while we're ahead.
Yeah.
John and Joe, thank you very much for your time. Everybody that joined us, thank you. I'll kick it back off to Ed that can tell people where the replay and things can be found. But thank you, gentlemen, very much for your time.
Thanks for having us.
That's going to be the quote we put at the top of this. This is going to be a great year for small business. We love that. That was a nice thing to hear as well. Gentlemen and Pete as well, thank you so much for this great conversation. Just a reminder to all of you, thank you for your time today. This will reside on the First Bank website. If you didn't get a chance to ask a question, you can email me at ed.hart. You can see my spelling of my name on the screen at FBOL, firstbankonline.com. We'll be happy to forward those questions to either Pete, Joe, or John and get answers back to you. Our next webinar will be in April. We do these quarterly. We'll be announcing the speakers in the coming week or two. And we look forward to having you join us as well. And feel free to share this content with your friends, your colleagues, others in your circle. We always want to do our best to educate you and bring content to you that's relevant. And if you have any suggestions for other speakers or panelists or topics, please feel free to reach out to me as well. We want to make sure that we're always developing this content around you, around what you're looking for as a business owner and a business leader. And again, just on behalf of First Bank and the entire team, including our host today, Pete Richardson, we'd like to thank Joe, John, and each of you for joining us today. We hope that this will have shed some more optimism on you if you're already feeling optimistic, and bring some optimism to you if you weren't. And we just ask that you, or just want to thank you again for your time today. And again, John, Joe, Pete, thanks for leading this discussion. And everybody have a wonderful week.
Thank you.
Everyone.
Thank you, everyone.